Welcome to Thoughts on Investing. Today, we're going to demystify two of the most common and, honestly, most confusing terms you hear in the investing world, the PE ratio and EPS. We're going to break down what they mean, how they're connected, and most importantly, how you can actually use them to make smarter decisions. All right, let's jump right in.
You've heard this before, right? A million times, maybe from a friend who's into stocks, or you see it on TV. It's one of those phrases that gets thrown around all the time, but what does it actually mean when a PE is too high? Is it always a bad thing?
That's really the big question, isn't it? How do you go from just hearing these buzzwords to actually understanding them and then using them to figure out if a stock is a good buy? Well, that's exactly what we're going to unpack today.
Okay, and before we dive in, just a quick and important reminder. This is all for educational purposes. It's not financial advice. The markets can be a wild ride, so please always do your own homework before making any investment decisions.
So here's our game plan. We're going to start with the absolute foundation, which is earnings per share, or EPS. Then we'll build on that to understand the PE ratio. We'll even peek into the future with something called the forward PE, and then we'll tie it all together so you can walk away with a tool you can actually use.
All right, part one. What exactly is earnings per share? Think of this as the bedrock, the absolute foundation of a company's profitability. In plain English, EPS tells you how much money a company made for every single share of its stock that's out there. It cuts through all the noise and just says, for each share, this is the profit. It's that simple.
And the math? It couldn't be easier. Seriously. You just take the company's total profit, that's its net income, and you divide it by how many shares exist. That's it. No complicated calculus here.
So let's look at an example. Say a company makes $1 billion in profit, and it has 500 million shares out there. Well, 1 billion divided by 500 million gives you an EPS of $2. That means for every single share, the company cranked out $2 of profit.
So why do we even care about this one little number? Well, because it answers some really critical questions. First off, is the company actually making money? Is that profit number going up over time, or is it shrinking? A steadily rising EPS is a fantastic sign of a healthy, growing business.
Okay, next up, understanding the PE ratio. Now that we know how to measure profit per share, let's connect that profit to the stock's price.
The price-to-earnings ratio, or PE, is probably one of the most famous metrics in all of finance. All it does is give you a quick way to gauge how expensive a stock is by comparing its price tag directly to its earnings. And once again, the formula is super straightforward. You just take the current stock price and divide it by that earnings per share number we just figured out. For example, if a stock is trading at $100 a share and its EPS is $5, well, 100 divided by 5 gives you a PE ratio of 20. So what does that 20 actually mean? It means investors are willing to pay $20 for every $1 of that company's profit. Now, here's a really great way to think about it. That PE of 20 means that if the company's earnings never changed, no growth at all, it would take 20 years for your share of the profits to add up to the price you originally paid for the stock. That really helps put the number in perspective, doesn't it?
Okay, part 3. Looking to the future with a forward PE. Because let's be real, when we invest, we're not buying the past, we're buying the future. So we need to look ahead.
The forward PE does exactly that. Instead of using last year's earnings, it uses what analysts expect the earnings to be over the next 12 months. This can give you a totally different view. A stock might look expensive based on its past, but look cheap based on the growth everyone's expecting.
All right, now for what is maybe the single most important rule of all of this. These numbers, they are totally useless without context.
This is the key takeaway right here. You never, ever judge a PE ratio by itself. A PE of 30 might seem high, but for a company that's growing its profits by 40% a year, that could actually be a bargain. For a company that isn't growing at all, that's crazy expensive. It's all about the context.
Let's just imagine two companies for a second. Both have a PE of 25. Company A has slowing growth and a ton of debt. Yikes, that 25 PE looks pretty risky. But Company B is growing like a weed, with great cash flow and a strong balance sheet. All of a sudden, that very same PE of 25 looks a whole lot more attractive. You have to look at the whole picture.
So, because context is everything, it's super easy to fall into some common traps. Let's quickly go over what you want to avoid doing.
Okay, big mistake number 1, buying a stock just because it has a low PE. That could be a value trap, a company that's cheap for a very good and very bad reason.
On the flip side, don't automatically run away from a high PE stock. You might be missing out on the next big growth story. You always have to dig deeper. Check the debt, the cash flow, and make sure those earnings are real and not just some one-time fluke. So let's put it all together. Here's your new, simple checklist. Number 1, is the company profitable? Check the EPS. Number 2, how expensive is it? Look at the PE. 3, what are the expectations for the future? That's your forward PE. And 4, the million-dollar question, is the growth rate high enough to justify the price you're paying?
Look, the market is often driven by fear and greed. Your job is to stay rational. Use these numbers as your tools. They're not a crystal ball, but they are a framework to help you cut through the noise, compare companies fairly, and move from just guessing to actually understanding what it is you're investing in.
And that's our look at PE and EPS. I really hope you found this helpful. If you did, please don't forget to hit that like button and subscribe for more. Thanks so much for tuning in.